And generally, I'm extremely positive about the market right now. We are seeing lots and lots of new buyers entering the space at our price point. And many of them are pretty early on their CDR buying journey. So the learnings that we've gotten from the big early customers are just kind of invaluable.
Welcome to Sustainability Leaders. I'm Michael Torrance, Chief Sustainability Officer at BMO. On this show, we will talk with leading sustainability practitioners from the corporate, investor, academic, and NGO communities to explore how this rapidly evolving field of sustainability is impacting global investment, business practices, and our world.
The views expressed here are those of the participants and not those of Bank of Montreal, its affiliates, or subsidiaries.
I'm Angela Adduci, Senior Advisor with the BMO Climate Institute, and today we'll be talking about carbon dioxide removal. To date, much of the work to limit climate change has focused on decarbonization, or reducing the volume of carbon dioxide that is emitted into the atmosphere. But in recent years, technologies to enable carbon dioxide removal, or CDR, have gained increased attention and traction across the globe. CO280 is a leading developer of large-scale CDR projects, and the company was recently awarded an offtake agreement with Microsoft, which will support a project to capture and permanently store carbon emissions from a U.S. pulp and paper mill. And this is one of the largest CDR purchases to date, and just one of more than 10 large-scale CDR projects that CO280 is developing by retrofitting existing pulp and paper mills to capture biogenic CO2 from boiler stack emissions for permanent geological storage. So we are so glad to welcome to the podcast the co-founders of CO280, Jonathan Rhone and Natalie Khtikian. And we also welcome BMO's Tansy Stobart, a subject matter expert on the topic of carbon dioxide removal and carbon trading. Jonathan, Natalie, Tansy, thanks so much for joining us.
Thank you.
Yeah, thanks for having us.
Let's start with you, Tansy. Could you provide our listeners with a little bit of context here about the state of CDR projects today across different sectors? And I'd be especially curious to hear how CDR project credits are currently trading in the market.
Thanks, Angela. I'd say the voluntary carbon market has evolved pretty significantly in the last couple of years. We have almost seen a bifurcation in the market. So the traditional voluntary carbon market, largely avoidance projects, and then the carbon removal or CDR market. The traditional market has experienced a challenging couple of years with oversupply, depressed pricing, and depressed demand. The CDR market, however, is relatively limited in high-quality, long storage supply, and demand is comparatively robust to what we'd call the traditional market. So it's an exciting space to be in CDR. Sketching out the CDR ecosystem, you've got nature-based and you've got long-duration or engineered solutions. So the nature-based pathways, you can think of afforestation, improved forest management removals, soil carbon and sequestration, or maybe mangrove restoration. These projects generally trade between, say, 10 and 80 US dollars per ton, and they're assumed to have a permanence of under 100 years. Permanence, of course, is the amount of time that we can assume that the CO2 is sequestered. This part of the market makes up the majority of spot available credits in the CDR space, with over 40 million or more tons issued to date. Then you've got the engineered or long duration removals side of the market. So think biochar or biomass burial or sinking, BECCS, which is bioenergy with carbon capture and storage, enhanced rock weathering, marine projects, direct air capture. There's several in there. I'd say the common thread here is permanence over 100 years, with most assuming over 1,000 years of permanence. Prices here vary, with biochar at the lowest end of the spectrum, between 100 and 200 USD on average, all the way up to DAC and marine project types, which can be 500 to 1,500 plus per ton. The one thing I'd say about CDR, the market in general, it's pretty nascent, with new deals being announced daily, which is exciting, but the buyer pool remains relatively small. You've got Microsoft, who's responsible for about 80% of cumulative purchased CDR volume to date, with a handful of other buyers engaged, also purchasing large volumes. You see successive buyers consortiums like Frontier and Symbiosis helping decrease risk and catalyze CDR investment, which is really heartening. But something we hear time and time again across CDR is how to get more players, more demand at the table alongside some of these big existing buyers. For us, that's really about helping clients who are new entrants or traditional VCM buyers looking to integrate CDR into their strategies to get comfortable with a few things, including portfolio design, pathway selection, price, due diligence, and contracting.
From Natalie and Jonathan's perspective, I mentioned this in the intro, CO280 recently signed a very large offtake agreement with Microsoft. And, as Tansy mentioned, they're making up about 80% of the market from the buy side right now. So what I also find interesting is that you've had recent deals with other buyers. So could you speak a little bit to your journey finding buyers for your CDR projects and what you've learned from the deal with Microsoft as well as deals with other buyers? And I guess to crystallize this question a little bit more, from your vantage point, what does the market look like?
First of all, thank you for doing this and thanks for having us. I've got a few things to say about, what we learned and the approach we've taken. First of all, in CO280, we're a technology agnostic project developer. So we have the luxury at the beginning of our journey of looking across at all of the different CDR pathways that Tansy mentioned. And, we came into this market thinking this market is going through a fairly significant shift as the demand for permanent CDR increases over time. You got to remember back in 2021, the market was really just getting started with like less than 100,000 tons a year. And now it's grown year to date, 13 million tons. So there's a whole bunch of criteria that buyers want. And so we decided right at the outset to build a project development company that was really kind of obsessed with customer needs. And so that led us to really focusing on the most advanced and educated buyers, the Frontier group of companies, Microsoft, JP Morgan, who were clearly establishing almost a procurement approach to buying CDR, which is fairly complicated. And they're laying down a tremendous body of learning and knowledge around how to approach building a CDR portfolio. So that's kind of number one. That's kind of an important background for how we approached it.
And I think we're really grateful for the early support from our first kind of handful of CDR partners, which are Microsoft, JP Morgan, and the Frontier members. We have learned a ton by working with those groups. And it's interesting. So CDR is, it's a bit different than the avoidance credit market that went before it, because you actually have to take action to remove carbon from the air rather than just avoiding an emission. So just from the nature of that, like the physics of it, it's a bit more expensive to do than avoidance, like no matter what method you use. And Tansy did a really good job of explaining some of the different methods that exist. So as a company, like with CO280, our goal is to build CDR projects that don't compromise on quality metrics that are really important, like permanence and additionality, but still have a price point that's around $200 per ton today, which is very affordable compared to other alternatives. And that has, worked for us as a thesis, and it allowed us to work with some of these big buyers who are really experts in CDR procurement. And generally, I'm extremely positive about the market right now. We are seeing lots and lots of new buyers entering the space at our price point. And many of them are pretty early on their CDR buying journey. So the learnings that we've gotten from the big early customers are just kind of invaluable. And those buyers know that they have a role to play in teaching others how to purchase CDR, because it's not currently super easy. I think one of the problems that the market faces right now to scale is just making it easier for customers to buy. But I am seeing that across different sectors of the Fortune 500, that there are folks actually dedicated to buying CDR on those teams. And it's a really hopeful sign to me.
Natalie, those are awesome points. I got two things to add. Specifically about what we learned from Microsoft and Frontier and from JP Morgan, our early buyers. Just to build on what Natalie said, first of all three of these buyers have made us a better supplier because they've given us feedback. If you look at what buyers care about, as you go through the procurement process with really educated buyers, they want to understand the entire value chain from which we're providing our CDR. So at the outset, we talked about, our CDR comes from capturing biogenic CO2 from boiler stack emissions at pulp and paper companies. We'll get into, how we do that in a second. But what that means from a buyer perspective is they're interested in the whole pulp and paper value chain. How are the forests managed? What happens at the mill in terms of energy balance and emissions? How our capture plant works, how we transport the CO2 that we capture to a storage facility. So all of the details around that whole value chain are really important for us to understand in depth from an engineering and technical standpoint, and also be able to communicate to buyers. Number one. Number two, I think we've learned a lot, Natalie, about, how to transact a long-term offtake contract with all of these buyers. And so, when we often talk in CDR, we talk about, we got to scale up the CDR market. We got to scale up CDR. Well, our view is, as a project developer, part of our job is to knit together all of the components of a project. So where's the CO2 coming from? What technology are we selecting? How are we going to actually store that? How do we build partnerships down the supply chain to transport and store it? How do we build partnerships with CDR partners? How do we put all those contracts together in a bankable, financeable, scalable package that we can develop a playbook around? Our first project that we sold these CDR offtake contracts into will cost $400 million. Future projects will be kind of double or triple the size of these. So we're talking about fairly significant capital intensive. So that's another thing we've learned.
Yeah, totally. So especially the first point you made, John, I think that when you're developing a project like this, you're making 100 micro decisions every day about how you're going to develop the project.
100%.
And as a team, CO280 is always thinking about the environment, number one, right? How to do things in a way that can scale and be bankable. And really importantly, also what our customers want, because our customers have that same set of goals as we do, which is making sure that we're doing the right thing for the environment in each one of those micro decisions, and also doing it in a way that can scale and have a big impact.
So we mentioned a few times Frontier, and our audience may not be familiar with what that group is, its significance in the market. So I'm hoping you could just briefly describe for our audience what Frontier is and how it might be different from a Microsoft or a JP Morgan.
Absolutely. Frontier is an advanced market commitment that was formed by Stripe, JP Morgan, Google, Autodesk, McKinsey, Salesforce, H&M, Shopify, and others, including Watershed, Canva, Samsara. There's a whole group of members who have made a commitment to actually purchase CDR before 2030. So the Stripe team and the founding members really looked at the CDR market and realized that there needed to be some sort of purchase commitment in order to get supply started and get engineered CDR projects off the ground. And they really filled that gap.
I want to add one more point to your question about, what does the market look like? We're very obsessed with the needs of customers. And so we're very obsessed with the needs of early pioneering buyers like the Frontier companies, like Microsoft, like JP Morgan. But what we see in the market from our vantage point now is we're taking that same customer obsession and we're learning about what the value drivers are for buyers in other market segments. Microsoft and many of the Frontier buyers are in the technology space. So those buyers have certain value propositions, certain value drivers about why they're buying CDR. But you look at the larger market, you've got companies that are in the aviation industry or pharmaceuticals or materials or energy or the shipping industry. Each one of those market segments fits into the carbon value chain in a different way. And so, our team spends a lot of time trying to understand what the value drivers are for those companies to buy CDR in the same way we've done it with the other buyers. And we think that customer-centric approach is a key part of not only growing the market, but building successful relationships with customers, and also providing a lens on how quickly the market will scale. And I think that's what drives our optimism, because we're seeing many new players from many new sectors getting ready to enter the market.
I have a couple questions about a couple things you guys said there. Any early insights you have yet from talking to some of these newer entrants in the market compared to some of the more established players? Are many following the rule book that many of these earlier investors have laid out and catalyzed in the market? Are they asking different kinds of questions? Anything you can share there?
It's a really good question. They're asking similar types of questions. And also, it's going to really depend on the stage that they're at in their journey. So some of them are exploring how CDR can fit into their decarbonization stack, their toolkit, because ultimately CDR is one tool out of a million different tools that these companies can use to decarbonize and reach their net zero goal. And like John said, the value of that is going to be different depending on essentially like all the different ways that that particular industry, that particular company can decarbonize. And so some of them are really thinking about it at that level still. And then some of them are just actually at the level of like looking at pathways and evaluating projects. And once they get to that level, they're looking at the same kind of quality parameters and the same kind of questions that the early customers are looking at.
So you mentioned that you guys lead with obviously the environmental impacts of the project in your discussions. I would say in the last couple months, I've heard some project developers, especially those developing engineered CDR in the US, for example, leading with what many might call in the carbon markets traditionally co-benefits to the carbon project. So for example, job creation, low carbon power generation, grid benefits, rather than the carbon or environmental benefit being the leading component of the project when talking to buyers and investors. Because in the end, CDR in many cases represents large infrastructure projects. Wondering if you have any insights or thoughts about messaging to buyers and positioning, or if you've experienced anything like that where the co-benefits from what we would, describe in the traditional VCM become a really large piece of the story.
It's a really good question. We definitely talk about the carbon benefits, the environmental benefits, but we also talk increasingly, I think, as we've actually begun to understand better, the economic benefits, the community benefits. And so just for a little bit of context, the pulp and paper industry in North America has been under a fair amount of competitive pressure from overseas for quite some time. And our pulp and paper mills, there's about 135 pulp mills in North America. Most of them were built in the 60s, 70s, 80s. They're older assets, they're smaller. And from time to time, the industry has been subject to curtailment of mills, and there's been mill shutdowns. They're also mostly located in rural communities. They're located in the middle of forests where the resource is. And so when there's a mill closure, it's a catastrophic impact to the community. And these mills employ 500-600 people directly, and then several thousand people indirectly around the whole ecosystem that supports the mill. Part of the exciting thing that we're doing with these projects, and this really relates to our business model, we actually joint venture the ownership of the carbon capture projects with our pulp and paper partners. So in other words, we develop, finance, and own and operate these projects under 50-50 joint venture partnerships with our pulp and paper partners. So they have a big stake in the ownership and sharing in the economic benefit of these projects. And with these long-term CDR offtake agreements, these are profitable assets. They are large infrastructure projects that are built onto the mill, so it's a big investment. And ultimately, the impact of the economics of our projects they can as much as double the EBITDA of a particular mill. So they can have a transformative impact, not only on the carbon profile of the mill and the industry, but also on the economic viability of the mill, which is really exciting, which also helps secure all those jobs in rural communities.
Tansy, the co-benefits that you're hearing other project developers and us talk about are very real. Like, we are literally protecting rural forestry jobs against offshoring pressure from Asia and South America. That's a fact. But what I mean when I say that we keep the environment first day to day is that every decision you make as a project developer can have an impact on the environment, right? And that could be a big decision, like where do we source the energy to power our carbon capture project, or what technology are we using? Or it could be kind of a micro decision that comes into play as we're developing the project. A great example of that is that we are really careful to treat flue gas. So we actually are doing quite a bit in our projects that doesn't necessarily like have to be done, because it actually makes the projects greener across the board. And that's what I mean, is that like as a project developer who cares about that, we make decisions all the time that make those credits truly have a clean and green impact.
This is really fascinating to hear about all the micro decisions that you're making every day, and often without perhaps a roadmap for how to make those decisions. I want to talk a little bit about cost, because we know that engineered CDR solutions are still pretty expensive. And when it comes to scaling, this can be an obstacle. So Natalie and Jonathan, how is CO280 thinking about bringing down the cost per ton of removals?
I think, first of all, as Natalie said, our current costs of our first project are less than $200 a ton. And our starting point cost basis is substantially more affordable than many of the other engineered solutions out there. And the reason for that is because there's some natural synergies between post-combustion carbon capture equipment and integrating it into an existing mill operation. These mills have been in existence for 40, 50, 60 years. And so they have a well-developed biomass supply chain. We don't have to develop that. The mill is in existence itself today. Mills produce, in the process of making pulp and paper, the mills have large biomass boilers. They make a lot of steam. They make a lot of power. They have infrastructure that can support a carbon capture plant that has to be co-located at the mill site. So there's a lot of synergies that are very helpful in driving down the cost. Also, the concentration of the CO2 in the flue gas has a direct impact on the cost of capture. So in our case, the CO2 concentration coming out of a recovery boiler at a pulp mill is between 12 and 14%. So that's 300 times more concentrated than CO2 in the air we breathe for, say, a direct air capture solution. So it's a lot less expensive to capture concentrated CO2 than it is to capture, less concentrated CO2. So we're already starting from a really great place. When it comes to thinking about how costs are going to come down, we have a number of natural advantages. We see the ability to reduce cost in kind of 4 areas. Number one, as we start scaling up, we've got about a dozen projects that we're working on, and each one of those projects are very similar, same type of technology, same type of value chain. So we're developing a standardized engineering package with our capture technology partners. SLB Capturi, which is a joint venture between SLB and Aker Carbon Capture, is developing a standardized modular capture plant. And as we start to deploy more and more of those at the same size, we believe we'll be able to drive costs down by achieving efficiencies in the value chain. We're also working very closely with our transport and storage companies. These are the companies that build the pipelines to the mills, and they transport the CO2 to storage. As we support the growth of that CO2 transport and storage network, it doesn't really exist today. It's just at the very early stages. As we scale up that network, that will create additional economies of scale that will drive down the cost of transport and storage, which is one of our biggest operating costs. Number 3, as we get more experience in being able to integrate the capture plant into the mill operations, we see opportunities for cost reduction in mill capture plant integration and optimizing the energy and utilities functions of how that interface happens. And number 4, as we scale up, we're hoping we can use more project finance, increase the amount of debt in our projects as we gain more experience and we gain the confidence of investors. So there's some examples of how we believe that we'll be able to go from where we are today, which is a very affordable price, and continuing to drive costs down as kind of a relentless improvement in efficiency and scale and supply chain development.
Turning to Tansy on the same question, what do you think needs to happen for CDR costs to come down, maybe more broadly?
Yeah, looking at the CDR market broadly, I think there's a few drivers for cost reduction, and John touched on many of them from the experience of CO280. But generally speaking, much of the technology in engineered CDR is at the high end of the learning curve. So many of these projects represent first commercial deployments, and some remain pretty low from a technology readiness level perspective. So obviously R&D will enable cost reductions as we go forward to 2030 and beyond. I'd say for biomass-driven pathways, access to cheap but high-quality biomass is key to driving down costs. Any sequestration pathways will benefit from cheaper storage costs, helped in part by, I think, increasingly strategic site selection for project sites 2, 3, 4, 5, and onward. So iterating on those learnings. And then, of course, as John was mentioning, economies of scale help as well to reduce costs across multiple pathways. John, touched on it, and I'd be remiss not to mention that the enabling of different financial products is also key to scaling and bringing down costs. So, for example, enabling debt financing so that a project owner's cost of capital isn't solely linked to equity. The final thing I'd say is we also need a bit of clarity on government subsidies. I think that's key for project owners to be able to model their costs and investment opportunity accurately for investors. And I think some clarity with time, ideally sooner rather than later, will help project owners, model those costs, as well as investors understand the benefits of government policies on CDR.
Natalie and Jonathan, we've spoken a little bit about where we think things are going in the market. Where is CO280 going next specifically? And I'd love to hear what projects you have in development and how you're thinking about the future more broadly.
So looking ahead at what's next for CO280, I mean, first of all, we've got a simple, audacious goal to be, the world's leading supplier of high quality, affordable CDR. And we're pretty excited about building out the pathway in the pulp and paper industry. We believe that not only can we supply and scale up CDR for our customers in the voluntary market and provide them with what they need, but we also believe that we can do it while having a very positive and transformative impact on the pulp and paper industry. And so in the near term, our focus is on getting our very first project in the Gulf Coast completed. All of the CDR contracts we've just talked about with Microsoft and Frontier and JP Morgan, those are all for our first project in the Gulf Coast. We're in final feed stage on that project and expect to get to FID in 2026. And then we've got another half dozen projects that we are actively working on as kind of the first cohort of projects with our pulp and paper partners. We're working with just about every single major pulp and paper company in North America to develop a first project with each one. And then we're working with the leadership teams of those companies on a plan to scale up CDR projects across their mill networks. So we're talking about a very significant market opportunity in North America that's worth something on the order of $30 billion a year. Longer term, we're always looking for the next generation of technology. We're looking at potential expansion into other geographic markets. But right now, it's laser focused on execution.
I agree with everything John said, and we're really excited about working with pulp and paper and the CDR community across this opportunity over the next few years, and that's where we'll be. So we're not going anywhere.
Well, it's really exciting to hear everything that CO280 is doing and all your plans for the future. So really appreciate the three of you coming on today and for a great conversation.
Thanks for having us. Really enjoyed it.
Thank you.
Thanks, Angela, and thanks, John and Natalie, for the conversation. I had fun.
Thanks for listening to Sustainability Leaders. This podcast is presented by BMO. You can find our show on Apple Podcasts, Spotify, or your favorite podcast player. Press the follow button if you want to get notified when new episodes are published. We value your input, so please leave a rating, review, and any feedback that you might have, or visit us at bmo.com/sustainability leaders. Our show and resources are produced with support from BMO's marketing team and Puddle Creative. Until next time, thanks for listening and have a great week.
For BMO disclosures, please visit bmocm.com/podcast/disclaimer.